Welcome back to the deep dive. Today, we're not just, analyzing some complex financial ideas. We are delivering a surgical blueprint, a plan for high earners who are facing, well, monumental tax bills.
And this is a very practical, proven framework. We're deep diving into a proprietary playbook. It's designed to legally transform these massive tax liabilities into powerful, wealth-building real estate assets in 2026.
Exactly. So our mission today is to break this strategy down piece by piece. The person who developed this playbook was facing a six-figure tax projection. We're talking a staggering $182,000.
hmm
And the goal was to legally get that liability down to zero, plus get a refund. So we're tracing the exact roadmap that gets you there using commercial real estate, surgical cost segregation, and a newly permanent federal tax law.
And what makes this source material so compelling is that it really documents the evolution of the thinking behind it. The initial wake-up call, that first maneuver, it happened really fast in December 2024 when that huge bill first came into focus.
That is the classic high earner moment, right? Staring down a giant check you have to write to the government.
Right. And the initial solution was, honestly, pure panic management. He was acquiring an 8-unit multifamily building in Whitestown, Indiana, closing the deal as fast as humanly possible, and immediately doing a cost segregation study,
Just to get the number down.
just to get the liability to zero for that year. It wasn't about the best deal. It was about speed.
Wow. So that sounds less like a strategy and more like a heart attack waiting to happen.
It was. The source material calls it brutal. Absolutely brutal. It cost the author weekends, massive amounts of stress, and the deal itself, wasn't necessarily the best long-term investment.
It was just the fastest.
The fastest available solution.
Yeah.
And that scramble is the exact pain point we are trying to eliminate with this 2026 playbook. The goal now is to move past that reactionary phase and build what they call a tax fortress, a scalable, audit-defensible system.
And the foundation of this fortress, the structural concrete, is a legislative change that eliminates that annual anxiety. Let's unpack the legal game changer that makes this whole playbook permanent.
Okay, so the major catalyst is a piece of legislation that was signed into law on July 4th, 2025. In the documents, it's referred to as the One Big Beautiful Bill Act. The formal name is Public Law 11921.
That name is definitely optimistic, but the impact is real. Tax benefits usually have these built-in sunsets or phase-down schedules, which is what caused that scramble in 2024.
Precisely. And the critical impact of this act is that it permanently reinstates 100% bonus depreciation. Before this, you had to worry about the deduction rate dropping from 100% to 80, then 40, then 20%. It created this massive time pressure.
Which means your tax planning was being driven by the calendar, not by smart investing.
Exactly. But now, if qualified property is placed in service after January 19th, 2025, you get that 100% immediate write-off on those short-life assets forever. It removes that arbitrary phase-down risk entirely.
So the strategic implication here is that the stability of this tax law, it changes the risk profile of real estate completely.
It absolutely does. This new permanence makes real estate the most reliable, powerful tax shield high earners have had in a generation. And it's particularly effective for asset classes like industrial and flex spaces, where you just have a higher concentration of components that qualify.
So it locks in your ability to turn paper losses into real tax savings.
That's it. These paper losses are just accelerated depreciation, but they create real, scalable tax savings.
Okay, so the law is the permanent foundation. Now we need the specialized tool to extract those write-offs quickly. That tool is cost segregation. But we are looking at it on steroids, paired with this 100% bonus depreciation.
Right. And cost segregation is an engineering study. It's not some accounting trick. Engineers physically go to a property and break down its components. So instead of treating everything as a 39-year building structure,
They reclassify things.
they reclassify assets like specialized wiring, landscaping, carpeting, exterior site work into much shorter asset lives, 5, 7, or 15 years.
And because of the new act, those newly reclassified assets, the 5, 7, and 15-year components, can be written off immediately at 100% of their cost in year one.
Correct. And that is why industrial property is the perfect target for this. Multifamily buildings are useful, but they just have fewer reclassifiable components. Industrial deals, warehouses, flex spaces, they have heavy-duty racking systems, massive HVAC upgrades, dock levelers.
They're essentially giant machines built to house production or logistics.
Precisely. The source material notes that you can often reclassify 35–45% of the total property value in a modern automation-ready warehouse.
Let's move past the mechanics and get to the numbers because this is really the jaw-dropping part of the playbook. The listener needs to see the concrete financial impact. Walk us through the comparison for, say, a $2 million industrial flex property.
Okay. If you approach that $2 million property using the traditional straight-line depreciation method, your total year one deduction would be maybe $69,000, which is nice, but it won't touch a $182,000 tax bill.
Okay, now what happens when we use the surgical approach cost segregation plus the permanent 100% bonus depreciation?
The total year one deduction just skyrockets. I mean,
Yeah.
we are talking about $751,000 or more in front-loaded paper losses
Wait, $751,000 on a $2 million asset.
in year one. Yeah, it's a truly massive loss generation.
So if the investor is operating in the top 37% tax bracket, what does that deduction translate to in actual cash savings?
That is $278,000
Hmm.
or more saved
Yeah.
in the first year alone. When you compare that level of immediate tax shield to, traditional investment vehicles, it's almost an unfair advantage.
And that $270,000 saved is immediate capital for the investor. It's not just a reduced payment, it's leveraged liquidity.
And that's the whole application of the strategy. That saved money is enough to fund the down payment for the next industrial deal. Legally, audit defensibly, and quickly. This is how you go from one-off deals to a scalable system.
That brings us perfectly to the challenge of scaling. The original playbook noted that self-funding that initial deal created a major liquidity problem. If you're a high earner, you have other things you need cash for. Tying up 25% down payments on $2 million assets repeatedly it's not sustainable.
High earners need rapid deductions, but they also need to maintain liquid capital. You can't fund 3, 4, or 5 of these properties by yourself.
So the 2026 solution is shifting to syndication using the Regulation D506B structure. Explain the mechanics of that shift and, crucially, how the general partner, the investor running this strategy, retains the full benefit of those deductions.
Okay, so the plan is for the general partner, the GP, to raise 50 to 70% of the required equity from passive investors, the limited partners, or LPs. The GP maintains control, earns the management fees, but here's the crucial tax mechanic. The GP is the one materially participating in the business.
Because the GP is actively managing the assets, coordinating the cost segregation, logging those hours, they're the one who can claim those losses.
Exactly. The tax code generally allocates the bulk of the depreciation losses to the person who is materially participating. So the GP gets the huge paper losses to offset their W-2 income, while the LPs get their smaller share of the loss to offset passive investment income.
And why 506B specifically over, say, 506C?
The source material focuses on 506B because it allows the GP to maintain investor privacy. You avoid general solicitation and the rigorous accreditation checks that 506C requires.
So it's a lower profile.
For a high net worth individual, yeah, that lower profile is often preferred.
So what's the pitch to the passive investors, since they are putting in most of the cash?
Stability and yield. Industrial syndications are attractive right now because cap rates are holding steady around 7.3%. Passive investors are looking for that predictable income stream, say 7 to 8% preferred returns, plus they get the tax shield on their own investment income.
And the source material connects this syndication structure directly to a specific market opportunity.
It does. The pro tip is to use syndication specifically for value-add big-box industrial plays. These are the larger assets, often shells, which currently have a higher vacancy rate, 14 to 17%, which means you can acquire them at a discount.
Hold on, 17% vacancy sounds pretty risky for a new playbook. Why intentionally buy assets with high vacancy?
That's where the value add comes in. You buy the discounted shell, you immediately execute the massive cost segregation study to harvest that depreciation in year one, and then you use the next 18 to 24 months to fill the asset as market absorption tightens. It's a bet on the market cycle recovery.
Which brings us to the location. Indianapolis. Why is the Indy industrial market the undisputed star for this 2026 strategy?
So post-2024, the Indianapolis market went through this supply surge due to massive speculative building, which caused vacancy to peak at 9%. But at the same time, new construction starts have dropped to a 5-year low because of capital and material costs.
So supply is drying up, but the local economy is generating enormous persistent demand.
Absolutely. The demand is driven by major regional logistics growth, Indy's central positioning, and huge local anchors, like the Eli Lilly EA District. Karakonde's Indianapolis Industrial Market 2026 Deep Dive Report highlights the tipping point. 2026 is projected to be the first time since 2022 that absorption will outpace completions.
That is the exact moment the pendulum swings back in favor of property owners. Let's review those key metrics from Condé's analysis so the listener knows what to look for. What's the entry cap rate?
The sold cap rate is holding firm at 7.3%. The advice here is pretty urgent. Acquire now before the Fed eases interest rates because those cap rates will compress. Entering at 7.3% is a lot better than chasing low 6 or sub 5% deals on the coasts.
And the rent forecast for existing spaces?
Asking rent per square foot, NNN, is around $10. The forecast projects moderate, stable growth of 4 to 6% year over year. The report emphasizes that high replacement costs make these existing rents a rock-solid inflation hedge.
And we noted that smart buying isn't just about square footage anymore, it's about the facility's capacity for the future.
That's a critical insight. Buyers have to focus on power and capacity. That means looking for sites with high megawatts per square foot for potential data centers or robotics facilities. They also must have automation-ready features, 40-foot plus clear heights, heavy floor loads. The sources warn that without these specs, you risk owning a stranded asset.
Okay, now we get granular. The submarket playbook, we have 3 target hotspots.
The playbook gives a risk-reward profile for each. First, for that syndication scale, higher risk value add play, you target West Hendricks County, so Plainfield and Avon. This is the institutional core, right near the airport and I-70.
And for higher potential upside with a bit less capital.
You look to the east submarket, primarily AMP Comfort. This is flagged as value add gold, offering discounted entry into those recently delivered shell buildings we were just talking about.
Okay, and finally, the quick cash flow option for the individual investor running their own deals.
That's the north-northwest area, including Whitestown and Zionsville. This niche caters to flex and light industrial for the affluent northern suburbs. Vacancy there is already razor-thin under 3%, which means strong, quick cash flow and faster rent growth.
There's also a forward-looking pro move mentioned, one that sort of hedges against the success of this whole strategy.
Right, that's the advice to prioritize fully entitled land for build-to-suit projects. Because capital costs are choking new construction starts, the supply of shovel-ready land is becoming constrained. The prediction is that land prices are going to climb fast.
Okay, this shift from panic to process requires a timeline. Let's lay out the systematic blueprint for the quarterly fortress. This is how the investor guarantees they never scramble again.
The schedule is tactical. Q1, January through March, is for planning. Run your full-year projection, confirm the 100% bonus depreciation elections with your CPA, and start scouting those AMP Comfort deals.
Q2 is all about building the funding structure.
Yep. April through June is for preparing the private placement memorandum for the syndication, pre-qualifying lenders, and actively targeting that West Hendricks institutional core deal.
Q3 is execution, and the deadline is critical.
Yes. The goal is to close by September 30th. This quarter means finalizing a letter of intent on a property, say a flex space in Whitestown, and immediately retaining the cost segregation engineer. Hitting that Q3 closing ensures the depreciation hits the books for the current tax year.
And Q4 is cleanup and forward strategy.
You finalize the cost seg studies, you prep any 1031 exchanges, and lock in those conservative 4 to 6% rent growth projections. It's organized. No more year-end pressure.
And finally, the most advanced strategic step without which this whole system fails. Logging 750 hours to become a real estate professional, or REP.
This is the ultimate goal. But it's also the biggest administrative burden and the #1 audit risk point. You have to log 750 or more documented hours across your real estate activities in 2026. This isn't just checking email, it's management, acquisition, financing, all of it.
You mentioned using tools like Toggle. Why is that detailed logging so crucial?
Because the IRS looks very closely at this. You have to prove, with specific contemporaneous logs, that you spent more than half your professional time on real estate, and that those hours were material participation. If you can't prove it, the IRS will challenge the REP status, and those patent losses revert to being locked away.
So the goal is to purchase an asset that provides a huge paper loss, fund it with other people's money, and then log your hours meticulously to unlock the maximum tax benefit.
Exactly. That REP designation lets those otherwise passive losses become active losses, which can then wipe out W-2 income completely, achieving that $0 liability fortress.
So to recap this whole deep dive, we've seen how the permanence of 100% bonus depreciation, combined with the surgical use of cost segregation and strategic industrial acquisition in the recovering indie market, creates a definitive, audit-defensible, tax-proof playbook for high earners in 2026.
For you, the listener, understanding this integrated combination, the new law, the GP syndication mechanism, and the hyperlocal market strategy is absolutely crucial. It's how you stop reacting to tax bills and start transforming those liabilities into powerful, leveraged assets.
Here's where it gets really interesting, though. If capital costs stay high and continue to choke new construction, what's the next evolution of this playbook?
Well, we noted that new construction starts are at a 5-year low. If that trend continues while demand stays strong, the real arbitrage opportunity in 2026 and beyond might shift dramatically. It might shift from acquiring existing depreciable buildings to simply acquiring and holding shovel-ready, fully entitled land before its value spikes as the inevitable supply crunch hits. That's the next layer of the fortress, purchasing the right ground for future development, and that is definitely worth mulling over as you design your own strategy.